Greetings. Today is Monday, January 3rd, 2022. So happy New Year to you. My name is Ted Hicks. I am the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. And we're going to do a brief monthly market monologue today because later this month, we are going to be doing a much more in-depth, what we call our State of the Union market and economic update. More details on that in just a minute, but you are all invited to join us to that more in a minute. So the S&P 500 in 2021 kicked off a return of approximately 27%. The problem with that is it really does not give an accurate picture of what happened in 2021. And so we're going to try to break that down real briefly for you today. The main point that I want to try to get across right now is the fact that a mere 25 of the 500 stocks contribute 40% of the index's return. Okay, so out of the 500 stocks that are in the S&P 500, only 25 of them account for 40% of the index's return. That's 5% of the index is kicking off 40% of the index's return. So that doesn't tell a whole picture when we say the S&P 500 was up 27%. One of the ways that we're going to look at what was the breadth? What was the participation in that advance? In other words, was all 500 stocks going up approximately 27%, or because of the fact that the index is cap weighted, was it really just the big stocks that went up? So when we look at breadth, we're looking at what percent of the S&P 500 is above their various moving averages. It's a way for us to measure how many stocks are participating in the advance. And I've got three measurements on the screen: the 20% or the 20-day moving average, the 50-day moving average, and the 200-day moving average. And we'll zero in on the 200-day moving average because, again, that generally is what's considered to be the indicator of whether a stock is in an uptrend or in a downtrend. And what I want to show is that since April, on the S&P 500, more and more stocks have been falling below their 200-day line, indicating that since April, more and more stocks were technically in a downtrend. So the analogy here is a military analogy. Think of the biggest stocks in the index as the generals and the smaller stocks as the soldiers. So if you think about probably a long time ago, perhaps Civil War time period, if the generals advance on an objective, if they advance on a hill or on a fort or something like that, if the generals advance and the soldiers do not follow, do you think the generals will be successful in that campaign? Many would suggest probably not. So inversely, if the generals advance and the soldiers are all following with them, that is generally a better indication that the military objective has a positive chance of being successful. So in this particular instance, there has not been a lot of participation in the advance. It's something we've been talking about all year. But let's look at a broader index, the NASDAQ, for example. The NASDAQ is very tech heavy, but it's also much broader. So the S&P 500, again, only has 500 stocks. The NASDAQ has approximately 3,000 stocks, okay? And what you see is I've got on the chart is January 25th. That's the high in terms of the breadth on the NASDAQ. So since January 25th, more and more stocks in the NASDAQ have been falling below their 200-day moving average. And right now, as the year begins, we have approximately 72% of that index that is still below their 200-day moving average. Then we look at the New York Stock Exchange. The New York Stock Exchange has, again, approximately 2,800 stocks compared to the 500, and same measurement. In this case, the high was January 20th, but again, ever since then, more and more stocks on the New York Stock Exchange were falling below their 200-day moving average. As the year begins, we have approximately 60% of the stocks on the New York Stock Exchange are below their 200-day moving average. So how about bonds? Bonds also had a very difficult year. Okay, so as measured by the iShares aggregate bond ETF, that ETF was down approximately 3.35% for the year. Now, it doesn't count the yield, okay, but we're just looking at the price measurement right now only. What about long-term treasuries? Long-term treasuries had a much more difficult year. You can see how deep that was in March, but by the end of the year, they still had approximately -5, almost -6% rate of return for the year in the bonds. So finally, that's all we're going to cover for today, but I want to let everybody know that later this month, on Friday, January 28th at 12 noon, we're going to host our virtual State of the Union event, and registration is free. We do need you to register so we can make sure we give you the link to the webinar, but this is open to all, and it's last year was very successful, the first year that we ever did it virtually, our highest attendance ever, so we're going to do it again virtually this year. Again, I'll put the link below so you can join us on Friday, January 28th at 12 noon for our State of the Union economic and market update. And you do not have to be a client for that. It is open to everybody. So I hope this was helpful, and I hope everybody has a happy new year. If you have any questions, feel free to reach out to me and my team. Thank you.